On a macro level, the American economy presents a profile of immense strength. Corporate valuations have reached heights that suggest a surplus of wealth is concentrated at the very top of the architecture. Behind those glass facades, the individual experience is different. For many, daily life is defined by a silent financial struggle that the broad economic indicators often fail to capture. Statistics show a widening gap in the labor equation. Workers are increasing their output and their hours, but their ability to retain that value in savings is shrinking. The common ambition has changed. For a significant portion of the workforce, the goal has shifted from building a legacy of wealth to the maintenance of basic month-to-month stability. This pressure is the result of specific, identifiable forces. When the cost of survival rises faster than the power of the paycheck, the value of that work begins to evaporate under the heat of a changing economy. Consider the impact of a salary that remains stagnant, while the price of every surrounding commodity moves upward. The most immediate pressure appears in the grocery aisles. Inflation on household staples acts as a direct tax on survival, eating into the disposable income that families once used to plan for the future. However, food costs are only one part of the barrier. The largest structural obstacle to building household equity is the housing market. High property valuations and elevated borrowing costs have made the traditional path to home ownership inaccessible for younger generations, removing the primary engine of middle-class wealth. When the majority of a paycheck is committed to rent or high-interest housing debt, long-term investments and business ventures are indefinitely postponed. Maintaining a baseline existence now requires a higher percentage of total income, leaving little room to hedge against future risks. To maintain that baseline, many households have turned to consumer debt to bridge the widening gap between their wages and their needs. Public perception often attributes this rising debt to luxury consumption or irresponsible choices, but the data suggests a different driver. Most household debt is incurred through medical emergencies, the rising cost of education, and the use of credit to cover the basic essentials of daily life. This is where the math of debt becomes a trap. When interest begins compounding on a balance that cannot be paid in full, the amount owed enters a state of exponential growth. External factors make this worse. When the central bank raises interest rates to combat inflation, the cost of carrying that existing debt increases immediately, without any change in the original amount borrowed. Eventually, the monthly cost to service the interest dwarfs the original principal, creating a cycle that is nearly impossible to break. In this system, a temporary financial bridge can easily transform into a permanent burden of interest payments. While national growth figures remain positive, individual workers are experiencing a sense of foundational instability. The rapid adoption of automation and artificial intelligence is changing the requirements of the job market, making many established career paths less secure. Corporate strategies prioritize efficiency and agility, often at the expense of long-term employee retention. The expectation of lifelong employment has largely disappeared. The modern worker is navigating a landscape where the cost of living is rising, debt is more expensive, and the employment foundation itself is shifting beneath them. Because traditional employment no longer provides a guaranteed safety net against these systemic pressures, the strategy for survival has had to evolve. Younger generations are moving away from the idea of a single passive career path. They're treating their financial lives with the same level of active management once reserved for businesses. This transition involves diversifying income sources. By leveraging digital skills and freelance platforms, individuals are attempting to build a hedge against the instability of any single employer. However, earning more is only a partial solution. Success in this environment requires a high level of active financial literacy. It requires precision in budgeting, the aggressive reduction of high-interest debt, and the consistent movement of capital into assets that can withstand inflationary pressure. In the current economy, the paycheck serves as the starting point for a broader strategy of capital management. The ability to manage and protect resources has become as necessary as the work performed to earn them. Success now depends on how effectively an individual can navigate the mechanics of a changing financial world.